When most people think about investing in the UK, they think about ISAs or pensions. But what many business owners don't realize is that your limited company itself can open a corporate share dealing account, allowing your business to invest retained profits directly into stocks, ETFs, bonds, or funds. Now, why would you do this? Well, if your company earns a profit, that money will usually either sit idle in a business bank account, or you extract it personally as salary or dividends. But once you extract it, you may immediately face dividend tax, income tax, national insurance, meaning you could lose anywhere from 8.75% to nearly 40% of that money depending on your tax band. Instead, by investing within the company first, those retained, and often dead, funds can begin compounding before any personal tax is triggered. So rather than taking £10,000 out, paying tax, and investing what's left, your company could invest the full £10,000 directly. And by allocating some of those funds into more established or lower volatility businesses, you may benefit from both capital growth and dividend income, effectively allowing your company to venture into wider markets and become a shareholder in some of the world's largest and most successful businesses, rather than leaving retained profits idle in cash. Over time, those investment returns may increase overall company profits, contributing towards distributable reserves in future accounting periods. This then opens up a number of strategic options for directors. For example, those enhanced reserves could support the payment of a larger dividend to the director, often taxed more favorably than salary, or allow the company to make employer pension contributions into the director's SIP, which are typically treated as an allowable business expense, potentially reducing corporation tax. Additionally, retained and invested profits could be used to fund legitimate business costs, supporting company cash flow, paying bills, or even facilitating capital purchases. This might include providing the director with a company car, which in certain cases, such as electric vehicles, may offer a more tax-efficient benefit than taking equivalent funds as personal income. Now, companies don't get ISA-style tax wrappers, so investment gains made inside the company are generally subject to corporation tax. However, corporation tax may still be lower than higher-rate personal dividend or income tax, allowing capital to potentially grow in a more tax-efficient environment initially, before being extracted later in a planned way. For consultants, property companies, and owner-managed businesses, this can be a powerful way to turn retained profits into long-term investment growth, while maintaining flexibility over how and when those funds are eventually extracted.